Let's connect with Manish Sonthalia, Senior Vice President, Head of Equity PMS with Motilal Oswal Asset Management. Manish, good morning and thank you for joining us. Manish, what do you make of yesterday's hope and hype rally? Do you think a bulk of the political adjustment is behind us, or now this is a new dawn? In fact, the political adjustment is yet to come.
Nikunj, I think markets are on course to hit 7,000 Nifty by March. I stick with that view. You may say that the result event on the election is over, but I think barring a few hiccups between now and March, you should see the markets trajecting higher. You have some data points, this Thursday, the CPI, the IIP, they are not going to be good. Then you have the 17th and 18th, the Fed commentary. You might see a repo rate increase by the RBI also on the 18th. But these are few minor incidents which can lead the markets to consolidate or take to see some profit taking, but only because of this. And beyond this, I think markets are headed higher. Maintain 7,000 Nifty, run up to the elections, all of that.
Manish, for markets to go higher, fundamentals also have to improve. Earnings have to bottom out. Margins have to expand. As of now, there is no evidence of that.
No, I don't know why you're saying that, because if you look at the last quarter numbers, top line has been a very healthy 20%. I understand part of that has been driven by export-related sectors. But on an overall basis, the last quarter numbers were better than estimates, and in fact, we have seen earnings upgrade happening for FY13 and FY14 and FY15 itself. So margin expansion, etc., should be there. Second half is typically a better earning season than the first half because it's the busy season. So I think earnings are there, and if you look at the valuations are not very prohibitively expensive. You're trading at 14 times FY15 earnings. How can you see markets bottom at, top at 14 times 1 year forward earnings? You cannot see markets topping out at 14 times, and that's really impossible.
Manish, that's a fair point that the aggregate P multiple for the Sensex is 14 or 15 times, but IT, pharma, FMCG and some consumer names are trading at P multiples of 30 times, even 40 times. So whereas one end of the market is sitting at historic low, the market which you own, the market which you like is sitting at historic high.
Yeah, so there could be a rotation trade. In fact, we think that cyclicals are about to make a comeback, and the ultimate cyclical in the economy is the banking sector, which is roughly 25-30% of the entire market. So this sector is going to lead the charge, and going forward. So there could be a rotation trade. There is a rotation trade which is happening, but a lot of junk stocks, low quality stocks are also moving up. The idea is to stay away from these stocks, to focus on quality. Yes, IT, pharma and FMCG, autos, these are some of the favored sectors. Earnings growth, visibility is there. We continue to stick with them, but that's not to say that cyclicals in the short term will not outperform. They might outperform, and they are outperforming.
From the index, two stocks have seen an extraordinary run-up in the last 8-10 days. Number one is ICICI Bank and the other one is L&T. Now that the hope trade is back, cyclicals are regaining momentum. Do you think there is still money to be made in ICICI Bank and L&T even after the recent run-up?
I think so. ICICI Bank is clearly undervalued even at 1,200 odd rupees. Given that their core ROE is closer to now 15%, and is trading at roughly around 1.2 times price to book on its core ROE. So I think even at 1,200 rupees, you have another 200-250 rupees upside in ICICI Bank. As far as L&T is concerned, I think it is seeing P multiple expansion. Valuations are expanding in line with other capital good infra plays. But at least this is the best of the lot. If you talk about anything which is the best in the capital goods infra plate is Larsen & Toubro. So we continue to have Larsen & Toubro in our portfolio. It's trading slightly expensive based on current fundamentals, but I think expectations are building up in the cyclicals per se, and that is why you are seeing some valuation expansion in the case of Larsen. It might sustain at current levels.
Manish, what's the sense that you're getting about the banking pack? Because the kind of rally that we've seen on a consistent basis, it clearly seems like there's a shift happening now towards the banking space. Are all the asset quality concerns over now, or is this again a part of the hope rally playing out?
Asset quality concerns are well known by the markets. The whole point is incremental deterioration in asset quality is diminishing. It's happening at a smaller pace or lower pace. So I think the real traction in the banking sector will come post announcement of the December quarter numbers, and which will begin in the month of January, where you'll see that the government's efforts on recovery, etc., are playing out well on the asset quality. Private sector banks in any case did not have too much of an asset quality concerns. Credit growth is a healthy 15%. NIMs have been protected. M2M losses on account of AFS and HTM have been taken care of by most of the banks in the last quarter. And valuations are still beaten down. So, I think there's a lot of upside in the banking sector per se. You stick to the quality names. You can stick to the Axis, the ICICI, HDFCs, or select private, public sector names as well.
Like?
We continue to like J&K, Bank of Baroda, PNB. These are some of the names which are there on the radar. J&K is something which we already own. State Bank of India, the ultimate representation of all PSUs per se. In fact, it has also rallied from its lows. So I think incremental, the rate of change as far as the deterioration in asset quality concern is slowing down, and that you'll see in the December quarter numbers.
The big laggards, Manish, have now tried to play catch up, and we saw that yesterday with the cement basket as well. Is there anything that you like out of the cement names?
I think the real hope trade is playing out in cement. You have problems of sand. Unless and until the Shah Commission gives out its verdict, construction is just not there, and we had all hope that before elections, the state election, there would be some pickup in construction activity. That has not happened, and part of that has been due to non-availability of sand. Demand is low, capacity is very, the utilized capacity is very low, costs are going through the roof, margins are suffering. So I am really not so bullish on cement unless and until I see uptick in volumes. That is just not coming in due to one problem or the other. Few select names in the cement space looks okay. Shree Cement looks quite good because they have been the most efficient, and they have been very prudent in pushing small volume expansion in their captive markets. But otherwise, per se, the outlook on the cement, I'm not so positive.
Manish, what's the take now on autos? Sure enough, there was an evident slowdown with the monthly sales data coming in, but would it be an opportune time to pick out anything from the auto basket?
Yeah, so I think if we are talking about cyclicals, autos also represent cyclicality. So within that, the passenger car segment is more cyclical than the two-wheeler segment per se, and that is why the whole euphoria about Maruti. And you have definitive reasons why yen to rupee equation is now turning much favorable. So you will see continued margin expansion, although there is hope that second half recovery in volumes would be there. The assumption is predicated on that. So I think Maruti has some more way to go, closer to around 2,000 rupees looks like a reasonable price for Maruti. M&M, again, UVs are not doing well, but the tractors are doing quite well. and SOTP valuations on M&M, at 970 odd rupees seems to suggest that there is another 10% or 12% upside based on our valuation, on assumptions that there will be some recovery in UV volumes as we move into the next fiscal year.
Manish, in the past you've run a very consumer-heavy portfolio. Are you revisiting that basic core of the portfolio?
No, if you look at the construct of my portfolio, 16% of the portfolio is in capital goods, infra, investment-related themes. So, some of the names that I have in my mid-cap portfolio would be a Container Corporation, a Voltas, an Engineers India, and one or two more. So I think if you look at the performance of these investment-related sectors, they have done very well. So, 120 rupees, Engineers India has gone up to 170. Voltas from 70 has gone up to something like 120. Container Corporation from 650 odd levels is now 730. So, even though consumption-related themes may have slowed down in the pace of appreciation, but I think the portfolio is perfectly hedged. 16% allocation is not a small allocation, and it is cushioning the small returns from the consumer-related stocks and getting some alpha on the portfolio from this space.
What I'm trying to gather from you, Manish, is that are you looking at selling out of consumers? You own a lot of Glaxo Consumer, you have a decent exposure to ITC, you own a lot of Emami. Are you now in a mood to reduce your exposure to consumer names?
Not really, Nikunj, the whole problem with the market is that a lot of low quality stocks are moving up, and definitely will not participate in any of the low quality stocks. So even though returns may be slightly muted, we'll stick with the quality names. So some of the names which you mentioned are there, but a few of them are still doing very well. Look, iShare is still doing very well. Page is still doing very well. And they are contributing positively to the returns of the portfolio. So, and you have decent visibility about earnings growth on these names. So, yes, people have been cribbing about valuations, but valuations are just holding out, and they're in fact moving up because you have quality earnings, you have cash flows, etc. So, I am not in a mood to switch out of or reduce allocation on the consumer names.
Manish, I'm sure before December 2014 we'll interact a lot, but hypothetically, let's say if we have to meet exactly after 1 year, what kind of market do you think we could be staring at? Which are some of the large cap gainers do you think will be up by 15, 20, even 25%?
I think banks will be much higher from these levels. This much I can tell you. The worst of the NPA cycle will play out by September 2014. So, and markets will pre-run all of that and, gauge the future. So we're talking about FY 15-16. Cyclicals will definitely do much better than what we are at today's levels. Consumers may be slightly higher from these levels. Autos will be in line with economic growth, so they will be higher from these levels. So I think on an overall basis, it will be banks, it will be some of the cyclicals which will be much higher. The secular names like the IT, the pharmas and the consumer will give you a 15-20% sort of a growth. And you'll see those sort of levels, the price levels appreciated by that extent exactly 1 year from now.
Okay, Manish, let you go on that note, and I'm sure we'll meet many more times before that 1 year time frame.